The dollar is dying. Here's what the rich are buying instead.
In 1971, President Nixon made a decision that was supposed to be temporary. 54 years later, we're still living with the consequences of that temporary fix. And it's about to catch up with every American who thinks their money is safe. Let me be frank with you. What happened back then set off a chain reaction that's finally coming to a head. You see, before 1971, every dollar in your pocket was backed by real gold sitting in Fort Knox. But when Nixon cut that tie, he promised it was just temporary until we could get our financial house in order. But we never really got our house in order, did we? Instead of that, we got addicted to something far more dangerous: printing money whenever we needed it. And now that addiction is about to destroy everything you think you know about money. Think about this for a second. When your money was backed by gold, there were limits. You couldn't just create more dollars without having more gold to back them up. It was simple mathematics. More money required more wealth. But once we broke that connection, all bets were off. Suddenly the government could fund anything they wanted just by firing up the old printing press. Need money for war? Print it. Economic crisis? Print more. Pandemic response? Print trillions. Problem is, every time they print more money, your money becomes worth less. We said it again, worthless. It's not some complex economic theory, it's just basic supply and demand. More dollars chasing the same goods means higher prices. Your paycheck buys less. Your savings lose purchasing power. Your future gets stolen, one printed dollar at a time. And here's what makes this even worse. They don't call it what it is. They don't. They use some fancy term like quantitative easing and monetary stimulus. But strip away the academic jargon and you know what you're left with? Government-sponsored counterfeiting on a scale that would make any crime boss jealous. In 2008, they printed over $1 trillion and told us it was necessary to save the economy. By 2020, they were printing $5 trillion. 5 trillion like it was just pocket change. That's more money created in months than existed in the entire American economy just a few decades ago. Now here's where it gets personal for you and for me. Every time they hit that print button, they're reaching into our wallet. They're diluting the value of every dollar you've saved, every dollar you've earned, every dollar you're counting on in retirement, devalued. The difference between now and 1971 is speed. Back then, the process took decades to play out. Now, with digital money and electronic transfers, well, they can destroy your purchasing power at the speed of light. Just like that. This addiction to printing money has created the biggest bubble in human history. And like all bubbles, this one is going to pop. The question isn't whether it's going to happen. The question is whether you're going to be in the right place when it does. Right now, while most Americans are still trusting the system, smart money isn't. It's moving. They're positioning themselves in assets that hold value when paper money falls. They understand something that took me years to learn. When the government starts printing money like there's no tomorrow, you better make sure you're not holding the bag when tomorrow arrives. The good news is you still have time. The bad news is that it's running out faster than most people realize. Now, to understand how dangerous this situation has become, you need to see the numbers. Let me show you exactly how much money we're talking about and why it's accelerating. In 2019, before the pandemic hit, the entire United States economy, every business, every worker, every dollar of output created by 330 million American workers for 365 days totaled about $21 trillion. Now get this. In just a few months during 2020, our government created $5 trillion out of thin air. Think about that. They created almost a quarter of our entire economy's annual output with the push of a button. But it gets even worse. That $5 trillion wasn't the first time they'd done this. After the 2008 financial crisis, they started something that they called quantitative easing. Sounds fancy, right? It's not. It's just a polite way of saying we're going to print trillions of dollars and hope nobody notices. Let me put this in perspective for you. Before 2008, this kind of money printing would have been considered economic suicide. Let me say that again. It would have been considered economic suicide. Central bankers would have been laughed out of the room just for suggesting it. But after 2008, it became the new normal. Every single one of these dollars they print comes out of your pocket. Not directly, they're too smart for that. They do it through inflation. They dilute the value of every dollar you own, every dollar you earn, and every dollar you've saved. And when they printed that first trillion in 2008, economists promised it wouldn't cause inflation. They said it would actually prevent deflation, falling prices. Well, they were wrong then. And guess what? They're wrong again in 2020. Remember when they said the inflation we're seeing was transitory? Well, that was in 2021. Here we are in 2025, still dealing with the consequences of their temporary money printing for 4 years ago. You know what's really crazy? They act like this is some kind of economic science, like they know what they're doing. But here's the reality. No country in history has ever successfully printed its way to prosperity. Not one. Every empire that tried it ended up destroying their currency and their economy. Rome did it by mixing cheaper metals into their silver coins. The Germans did it after World War I, printing marks until people needed wheelbarrows full of cash to buy a loaf of bread. And now we're doing it digitally, creating trillions with computer keystrokes. The difference is speed. When Rome debased their currency, it took decades. When Germany did it, it took a couple of years. When digital money came into the equation, well, we can now destroy currency's value in months or even weeks. But here's the part that should really worry you. Listen carefully. Each time they print money, it gets easier to print more. The first trillion, well, it felt like a big deal in 2008. The 5 trillion in 2020, they barely blinked. What's next? 10 trillion? 20 trillion? Where does it stop? I'll tell you where it stops. It stops when people lose faith in the currency altogether. When businesses stop accepting dollars. When other countries refuse to trade with us. When the whole system collapses under the weight of its own contradictions. And we're not talking about some distant future here. The cracks are already showing. Countries are starting to make deals in other currencies. Central banks are buying gold instead of dollars. The writing is on the wall for anyone willing to read it. The people in charge know this. They know it's unsustainable. They're not stupid, but they're trapped in a system that requires more and more money printing over and over again just to keep functioning. They can't stop now without causing the very collapse that they're trying to prevent. So they keep printing. They keep spending. They keep inflating away your wealth and keep hoping they can manage the landing when the whole thing comes crashing down. The question you need to ask yourself is this: do you really want your bet to be on your financial future, on the ability to pull off the impossible? Here's the big thing. The rest of the world is starting to figure this out. Major institutions and entire countries are quietly preparing for what comes next. You want to know how serious this is? You want to know how serious it's getting? Let me tell you what the people with real money are saying when they think nobody's listening. The Guardian, it recently published something that should have been front page news everywhere. Trust in the United States dollar is eroding. The question isn't if the dollar will lose supremacy, it's when. That was a headline in a newspaper. Not if, when. JP Chase, one of the biggest banks in America, is now openly talking about something called dollarization. Dollarization. It's a fancy term for the dollar losing its dominance in global trade. Now, these aren't conspiracy theorists on YouTube. This is JP Morgan. BlackRock, the world's largest asset manager, controlling over 10 trillion in investments, recently told their clients that a declining dollar means more international exposure, and it's necessary. Translation: get your money out of dollar-based assets before it's too late. But here's the kicker. Larry Fink, the CEO of BlackRock, recently said in an interview that Bitcoin could replace the dollar as the world's reserve currency because of our massive national debt. Let that sink in. The head of the world's biggest investment firm is saying a digital currency created only 15 years ago might be more trustworthy than the dollar that's dominated global finance for 8 decades. These people don't make statements like that lightly. They have trillions of dollars under management. Their job is to preserve and grow wealth for the biggest institutions and richest families in the world. And when they start questioning the dollar's future, you better pay attention. But it's not just American institutions that are sounding the alarm. Countries all around the world are making moves that would have been unthinkable just a few years ago. China and Russia are conducting trade deals in their own currencies. They're bypassing the dollar entirely. Brazil, India, and South Africa are joining them. Now, these aren't small countries. We're talking about these are major economies representing billions of people. They call themselves the BRICS nation, and they're working on creating their own currency system that could be backed by gold. Real gold. The kind of backing that we abandoned in 1971 with old Tricky Dicky. And here's what's really telling. Central banks around the world are buying gold at rates we haven't seen in decades. Check the value of gold today when you listen to this video. They're not buying dollars, they're not buying treasuries, gold. They're preparing for a world where paper promises don't mean much anymore. Poland moved a huge chunk of their gold reserves back to their own country from storage in London. Same with Germany. These countries are literally bringing their gold home because they don't trust leaving it in foreign banks anymore. They've lost faith. Turkey, despite being a NATO ally, has been buying massive amounts of gold and reducing their dollar reserves. Even our allies are hedging their bets against our currency. Now, you know what all of this tells me? The smart money doesn't just see problems with the dollar, they're actively preparing for its decline. They're not waiting for the mainstream media to sound the alarm. They're not waiting for government officials to admit there's a problem. They're moving now while they still can. And here's the part that should worry every single American. When the world loses faith in your currency, it doesn't happen gradually. It happens fast. One day you're the reserve currency, the next day nobody wants to hold your money. Ask the British. The pound sterling was the world's reserve currency for over a century. Then almost overnight, after World War II, it was replaced by the dollar. The British went from being the financial center of the world to being just another country with money troubles. The same thing happened to every reserve currency in history, ever. The Spanish currency, the Dutch guilder, the French franc, all of them dominant until they weren't. Well, what makes anyone think that the dollar is going to be different? You tell me. What makes anyone think they're immune to the same forces that brought down every other empire's currency? So if the writing is on the wall, and now you can see that it is, if smart money is moving and you can see that it is, what exactly are they moving into? Well, there are 4 specific asset classes that wealthy investors and institutions are using to protect themselves. So let me be clear about something first of all. I'm not telling you to panic and dump all your investments tomorrow. It's not what I'm saying. That's not smart. But I am telling you to understand what your options are and why these 4 assets matter when currencies start falling. Asset class number 1, that's physical gold. Gold has been the money for over 4,000 years. Empires rise and fall, currencies come and go, but gold endures. There's a reason that central banks around the world are buying it right now by the ton. And what makes gold different from paper money is that it takes real work to get it out of the ground. You don't just fire up the printer when you need more money. There's a limited supply, and that supply grows slowly, very slowly. And when people lose faith in paper money, well, they run to gold. It happened after the 2008 crisis. It's happening now, and it'll happen again next time the system cracks. But let me give it to you straight. Gold isn't a get-rich scheme. Or from 2012 to 2020, gold prices, well, they actually fell. It took 8 years to recover. People who bought at the peak in 2011, they lost money for almost a decade. Why? Because when things stabilized after the 2008 crisis, investors, well, they got comfortable again. They wanted growth, not safety. So they sold their gold and they bought stocks. So here's the lesson. Gold moves up when people are scared about currencies and down when they're confident. Right now, with all the money printing and institutional warnings, people are getting scared again. The BRICS countries that I mentioned earlier, they're not just buying gold for fun. They're working on creating a gold-backed currency to compete with the dollar. Now that's real demand from real countries representing billions of people. Okay, asset class number 2, real estate. Been in real estate for decades, so I'm kind of biased here. But there's a reason wealthy families have always owned land and buildings. You can see them, touch them, and use them. When currencies fall, real estate will typically rise in price. Why? Because it's a hard asset denominated in that falling currency. If dollars become worth less, it takes more dollars to buy the same property. But here's what makes real estate better than gold, in my opinion. It produces income. A rental property generates cash flow every single month. Gold just sits there looking shiny. Real estate also has what I call disaster insurance built in. Now, if the worst case scenario happens and our currency system collapses totally, which I'm not predicting, I'm just explaining, you still own something useful. People need places to live regardless of what kind of money they're using. Asset class number 3, foreign investments. Now, this is where it gets interesting. Instead of putting all your money in US companies that depend on the dollar's strength, some investors are diversifying internationally. Now, the logic is simple. If the dollar weakens investments, then investments in other currencies might hold their value better. If other economies grow while ours struggles, their companies might outperform ours. Now, investing in foreign countries, well, it can be complicated. Different laws, different currencies, different risks. But there are ways to do this without becoming an international finance expert. Exchange-traded funds, EFTs, well, they make this accessible. You could buy a fund that invests in developed economies like, Europe, Japan, Australia, New Zealand, or you can get exposure to emerging markets like India, Brazil, and smaller growing economies. The developed market funds are generally safer but offer less growth potential. The emerging market funds are riskier but could deliver higher returns if those economies continue developing. Here's the catch. You're not just betting on those companies doing well, you're also betting on their currencies holding value against the dollar. Now, if the dollar stays strong, your foreign investments, well, they might underperform even if the underlying companies do great. Asset class number 4. Bitcoin. This is the newest and most controversial asset class. Bitcoin was created as a response to the 2008 financial crisis. Digital money that no government can print, no central bank can control. Some very smart people think Bitcoin could eventually replace the dollar as a global currency. Others think it's digital fool's gold. I don't know. The truth is probably somewhere in between. What is undeniable is that Bitcoin has gained acceptance from major institutions. Companies like Tesla and MicroStrategy have put it on their balance sheets. Major banks now offer Bitcoin services to wealthy clients. Now, the appeal is obvious. There will only ever be 21 million Bitcoin. No politician can decide to create more. No central bank can inflate away its value through more money printing. But let me be frank with you, Bitcoin is volatile as hell. It really is. It can drop 50% in a month and double its value just as quickly. It's not for everyone. It's definitely not for money you need in the short term. The people buying Bitcoin as a hedge against dollar devaluation, well, they're thinking long term. They're betting that in 10 or 20 years, people will trust a mathematically limited digital currency more than they trust politicians with printing presses. Not a bad bet. Now, here's what all of this means. These 4 asset classes, gold, real estate, foreign investments, and Bitcoins, share one common characteristic. They're alternatives to holding pure dollar-denominated assets. Smart money isn't putting all their eggs in one basket. They're diversifying across different asset types, different currencies, different countries. They're preparing for multiple scenarios. Key word here is diversification. Not putting everything in gold, not putting all in Bitcoin, not selling everything to buy foreign stocks. Spreading risk across assets that react differently to currency problems. Now here's where most people make their biggest mistakes. They wait until everyone else figures this out before they take action. And by then, well, it's too late to position yourself advantageously. Think about it this way, the best time to buy an umbrella is when the sun is shining, not when it's raining, right? Right now, you're seeing a storm cloud brewing on the horizon, but most people are still enjoying the sunshine. Now, I don't think you should panic. Panic leads to bad decisions, and bad decisions destroy wealth faster than any currency crisis ever could. But I do think you need to understand what's happening and position yourself accordingly. The changes we're talking about don't happen overnight. They happen slowly and then all at once. What separates the smart investors from everyone else is that they position themselves for multiple scenarios. They don't try to predict exactly when or how the crisis will unfold. They just make sure that they're protected regardless of what happens next. If the dollar stays strong and continues as the world's reserve currency for another decade, diversified investors, well, they're still going to win. Their gold might not skyrocket, but their real estate produces income. Their foreign investments capture global growth, and their diversification protects them from any single market crash. If the dollar weakens gradually over time, well, they win bigger. Their hard assets raise and rise in price. Their foreign investments benefit from currency exchange rates, and their alternative assets protect their purchasing power. If the dollar faces a crisis and loses reserve currency status quickly, they win the biggest. While everyone else scrambles to figure out what to do, they've already positioned themselves in assets that hold value when paper money falls. That's what smart positioning looks like, by the way. You're not betting anything and everything on one outcome. You're preparing for the most likely scenarios while protecting yourself from worst case ones. See, most financial advisors, they won't tell you this, but the traditional approach of putting everything in stocks and bonds worked great when the dollar was stable and when it was growing stronger. However, that era might be ending. The people managing the biggest pools of money in the world, pension funds, sovereign wealth funds, family offices, they're not waiting around to see what happens. They've already started diversifying into the asset classes that we've talked about. You know what's interesting? The wealthy have always done this. They've always owned land, gold, and businesses in multiple countries. It's the middle class that got convinced to put everything into paper assets and hope for the best. 401k. Now, I want to be crystal clear about everything, especially something. Investing in any of these assets carries risk. Gold can fall, foreign investments can underperform, and Bitcoin can be volatile as hell. But here's the thing about risk. The biggest risk of all is doing nothing. Sitting in dollars while the purchasing power gets inflated away. Watching your savings lose value while you wait for someone else to tell you it's time to move. The window for positioning yourself advantageously is still open, but it won't stay open forever. When mainstream media starts talking about dollar devaluation daily, when your neighbors start buying gold, and when Bitcoin hits the evening news every night, that's when you know the easy gains are behind us. Time's up. Game over. Right now, though, you have an advantage. You're seeing this before the crowd does. You understand what smart money is doing while most people are still trusting the old playbook. The question isn't whether these trends will continue. The mathematics of money printing, the international pressure that's coming down on dollar dominance, the institutional warnings, they're all pointing in the same direction. The question is whether you'll act on this information that you're hearing now to position yourself properly. Here's what I recommend, and this isn't financial advice because I'm not a financial advisor, just someone who's been watching markets for decades. Educate yourself. Understand these asset classes. Consider how they might fit into your overall financial strategy. Don't put all your money into any single asset. Don't sell everything tomorrow and buy gold. Don't mortgage your houses to buy Bitcoin. They're not smart. It's not smart positioning. It's gambling. It's rolling the dice. Smart positioning is gradual, measured, and diversified. It's understanding that the financial world is changing and then adapting accordingly. The wealthy didn't get wealthy by following the crowd, did they? They got wealthy by seeing changes coming and then positioning themselves ahead of the change. You have the same opportunity right now. You really do. The information is available. The assets are accessible and the window is still open. The choice is always yours. You can keep doing what everyone else is doing and hope that it works out. Or you can start thinking like the people who've built and preserved wealth through every financial crisis in history. What did they do? Repeat that. Do that. But don't wait too long to decide. In the investment world, timing isn't everything. It's not. It's a lot more important than most people realize. The storm clouds, well, they are gathering. The smart money, it's moving. And the question is, will you be ready when the weather changes? Look, if this information opened your eyes to possibilities you hadn't considered before, do me a favor. Share this with someone you care about. The people closest to you, they deserve to understand what's happening as well. And if you learn more about building wealth outside of the traditional system, I've put together additional resources that can dive deeper into these strategies. Click the link in the description below. Or you could visit legacywealthmasterclass.com, where you can learn how to get into multifamily deals by being what we call a deal finder, a partner if you will. This is more for the active investor that has more money than time. You know the guy looking for sweat equity, so to speak. The financial world is changing whether we like it or we don't. The question is whether you'll change with it. If you got some value out of this video, be sure to like and subscribe. You know what to do. Click the bell to get notified when I post new videos. I'll see you in the next video, which you can access it right here. And I look forward to talking again with you soon.